Institutional investors represent organizations that manage large pools of capital on behalf of beneficiaries, participants, or stakeholders. Major institutional investor categories include pension funds, sovereign wealth funds, university endowments, private foundations, banks, and insurance companies. Although these institutions differ in objectives and liabilities, they share several common characteristics that distinguish them from individual investors. Institutional investors typically operate on a larger scale, possess more formal governance structures, face specific regulatory and accounting requirements, and often maintain longer investment horizons. Their investment programs are designed to meet organizational objectives rather than personal financial goals. Understanding these common characteristics is essential because they influence portfolio construction, risk management, asset allocation, and investment policy development. Scale is one of the defining features of institutional investing. Institutional portfolios often manage billions of dollars, allowing access to investment opportunities that may be unavailable to individual investors. Large scale creates advantages such as lower transaction costs, broader diversification opportunities, and the ability to invest directly in alternative assets including private equity, infrastructure, and real estate. However, size can also create challenges. Very large institutions may encounter capacity constraints when investing in smaller asset classes or specialized strategies. As a result, some institutions choose to manage assets internally rather than relying exclusively on external managers. The scale of institutional portfolios significantly influences investment implementation decisions and the range of available investment opportunities. Institutional investors generally maintain longer investment horizons than individual investors because their objectives are linked to long-term liabilities and organizational missions. Pension plans, endowments, and sovereign wealth funds often invest with horizons extending decades into the future. These extended time horizons allow institutions to tolerate short-term market fluctuations while pursuing long-term return objectives. Longer horizons also support allocations to less liquid investments that may offer higher expected returns. At the same time, institutions must carefully evaluate future obligations and ensure sufficient resources are available to meet commitments. Consequently, investment strategies must balance return generation with prudent risk management and liability considerations. Time horizon remains a fundamental driver of institutional asset allocation decisions. Governance and regulatory frameworks are additional characteristics that differentiate institutional investors from individual investors. Most institutions operate under formal governance structures consisting of boards of directors, investment committees, and professional investment staff. These entities establish investment policies, oversee risk management, monitor performance, and ensure compliance with fiduciary responsibilities. Institutions are also subject to legal, regulatory, accounting, and tax requirements that vary by jurisdiction and organizational type. Regulatory oversight often affects permissible investments, leverage usage, reporting requirements, and funding obligations. Strong governance structures support disciplined decision-making and accountability while helping institutions maintain alignment between investment activities and organizational objectives. Principal-agent relationships are particularly important in institutional investing. A principal-agent conflict arises when individuals managing assets may have incentives that differ from those of the asset owners or beneficiaries. Within institutions, these conflicts can occur between beneficiaries, boards, investment committees, internal staff, and external asset managers. For example, an external manager may prioritize asset growth and fee generation over maximizing beneficiary outcomes. Effective governance structures, performance measurement systems, incentive alignment, and oversight mechanisms help mitigate these conflicts. Institutional investors must carefully manage principal-agent relationships to ensure that investment decisions remain consistent with fiduciary obligations and stakeholder interests. Addressing these conflicts is an essential component of institutional investment management. Pension funds are among the most significant institutional investors globally and exist to provide retirement benefits to employees. Pension plans generally fall into two categories: defined benefit (DB) plans and defined contribution DC plans. In a defined benefit plan, the sponsor promises a specified future benefit, making the sponsor responsible for funding shortfalls and investment risk. In a defined contribution plan, contributions are predetermined, and investment risk is borne primarily by plan participants. These structural differences significantly affect investment objectives, liability characteristics, risk tolerance, and asset allocation decisions. Understanding the distinctions between DB and DC plans is fundamental to analyzing pension fund investment policies. For defined benefit pension plans, liabilities play a central role in portfolio management. Future benefit obligations depend on factors such as employee salaries, years of service, retirement age, and life expectancy. Changes in these variables directly affect the present value of liabilities and the plan's funding status. Pension fund managers therefore focus not only on asset performance but also on the relationship between assets and liabilities. Liability-driven investing approaches are commonly employed to manage funding risk and improve the likelihood of meeting future obligations. The plan's funded status, demographic profile, sponsor strength, and cash flow requirements all influence investment strategy and risk tolerance. Effective management requires continuous monitoring of both assets and liabilities. Pension fund asset allocation is influenced by the plan's objectives, funding position, participant demographics, and sponsor characteristics. Plans with long horizons and strong funding positions may allocate substantial portions of assets to equities and alternative investments to pursue higher returns. Conversely, mature plans with significant near-term benefit obligations often emphasize fixed-income investments and liability matching strategies. Risk tolerance may increase when plan assets have low correlation with sponsor operating performance because the sponsor is more likely to support contributions during adverse market conditions. Ultimately, pension fund investment management seeks to balance return generation, liability management, and risk control. This balance ensures that promised retirement benefits can be delivered while maintaining the long-term financial health of the pension system.